Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Abcellera stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Abcellera is a biotechnology company that uses its proprietary database to research and develop human antibodies to address pandemics and common diseases. The company establishes partnerships with small, medium, and large drug companies. Those companies tell Abcellera the idea for the therapeutic agent, and Abcellera performs the entire discovery process and validates the work. It then turns everything over to the drug company for clinical trials. It locks in royalty agreements with other companies, which creates a long and healthy revenue stream. Most of its revenue comes from royalties. The company is headquartered in Vancouver, British Columbia, Canada, and was founded in 2012. The ticker trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 2.1 billion market cap. They're trading at $7.34 a share, and they have 286 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They are doing a good job at growing their free cash flow. It was negative in 2019, up to $200 million in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also looks really good, from negative $2 million to $159 million. Revenue is the sales for the company, and that's grown a lot, from $12 million to $233 million to $375 million, close to $500 million. This is the company's income statement. The top line is the revenue, the sales. That was $485 million in 2022. Let's dig into this number a little more so we know what it is. Of the $485 million of revenue, $443 million is from royalties. It receives royalties on the antibodies it develops. And they also charge other companies research fees. That was $41 million. Licensing and milestone fees are insignificant. They did receive $21 million of licensing fees in 2021 and $8 million of milestone fees in 2021. But 2022, those numbers are really low. Let's go back to the income statement. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. These are all the costs to develop the antibodies. Cost of payroll, cost of machinery. Revenue minus cost of revenue gives you your gross profit, and they're really high gross margins. Below that is their operating expenses. They spend a lot of money in R&D, research and development. Gross profit minus operating expenses gives you your operating income. And that grew a lot, from negative $2.3 million to $227 million. They have really high operating margins. They were higher in 2021, but they're still pretty high in 2022. They received $16 million of interest on their investments. They paid $4 million of interest on their debt. Then you have other income and expenses, which are all the gains or losses not part of the company's core operations. That's really low. Then your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which was the highest in 2022 at $159 million. The antibodies they developed for COVID were the main source of their revenue. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You can think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So in 2022, they generated $277 million of cash flow, which is more than 2019, 2020, and 2021 combined. Then you have capital expenditures, investments in property, plant, and equipment. They spent $73 million of CapEx in 2022. Operating cash flow minus CapEx gives you your free cash flow. They don't pay a dividend or buy back stock, so they're using their free cash flow to grow their business. They did pay down most of their debt in 2020. They paid down $20 million. Part of the money they received from going public, they used that to pay down debt. That's a common use of IPO funds, to pay down debt. Financing cash flow is when a company receives debt or equity, or pays debt or equity. They received $684 million in 2020, so that must be from the IPO. Let's look at the capital structure. $118 million of equity, $82 million of debt. They're 59% equity, 41% debt. And they could pay off all the debt with the cash on their balance sheet and still have $800 million of cash left over. I gave them the middle whack on Finbox, 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.5 billion. We divide that by 286 million shares. And we get a calculated stock price of $5. They're trading at $7, so they're trading at a 40% premium. It's a sell according to the model. 7 analysts project their 2025 revenue to be $76 million. Their 2024 revenue is projected to be $66 million. 2023 is $52 million, a big drop off from 2022. I continue this trend into 2026 and I got $86 million. That's how I got the future revenue estimates. They convert on average 45% of their revenue into free cash flow in 2021 and 2022. So I multiplied their future revenue estimates by 45%. That's how I got their future free cash flows. It is a hard company to value using a DCF because it really depends on if they're going to develop an antibody and if it's going to be successful. The website Simply Wall Street is a lot higher than me. They're at $16 a share. They're saying it's 53% undervalued. 6 analysts priced this stock and the average price target is $30. The low is $18, the high is $38. Another 9 analysts priced this stock and the average price target is $28. This is where the stock has been trading since it IPO'd. So it looks like I got pretty close to $60 a share, but it's been dropping ever since. I bought the stock in July of 2021 for $16 a share, and I was up 20% after a few months, so I was really happy. Now I'm down like 40-50%. I did buy more stock for around $9 a share, so I'm down on that as well. But I plan to hold this. I really have faith in the company. I like what they do. They have a negative beta, which you don't see too often. That means the stock moves opposite the market. It's down 28% in the past 52 weeks, while the S&P is down 10%. The 52-week low is 542. The high is 15. And the stock is trading below its 50-day and 200-day moving average. About 1.5 million shares are traded each day on this stock. Of the 288 million shares outstanding, 209 million are on float, 47% are held by institutions, and 15% of the shares on float are shorted. If you put $10,000 into this company when they started trading, you'd be at $1,500 today. That's an 85% total loss. The CEO's salary is $400,000 and the total compensation package is $9 million. In the past 12 months, there's been only insider buying, no selling, so that's a really good sign. The CEO buys a lot of shares, 1.4 million, 200,000, 85,000, another 300,000, another insider bought 200,000, another one 85,000. Andrew Booth got a really good deal at $579. He paid the lowest. 45% of the company is held by institutions, 27% by the general public, and 27% by insiders. Their employee count seems to be going up year after year. They currently employ 495 people. The CEO of the company, Carl Hansen, owns 20% of the stock. Then Bailey Gifford, BlackRock, Voya, and Baker Brothers. The best way to look at ratios is to compare them to companies in the same industry. There are 716 companies in the same industry as Abcellera. And if Abcellera has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they do spend more than average in CapEx. Their debt to equity ratio is a little worse than average. They are generating positive free cash flow. The average company is negative. They rank 58th in market cap of the 716 companies. Their price to book is worse than average, but their PE, price to free cash flow, and price sales are better than average. They generate a little more revenue than the average company, and they do have a positive ROA and ROE since they have positive net income. So to summarize, I have them trading at a 40% premium, but I am bullish on this stock. I realize their revenue projections for the next few years are modest, but anything can change, especially if they work with a big company like Merck to develop a drug and it becomes a blockbuster hit. Then this company will be swimming in money. But I know they have lots of things in the pipeline, so I'm really hoping the company continues to grow and becomes really big and scales. I rank their free cash flows, revenue, and ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.